Hey everyone, welcome back to Corporate Decoder. Today, Q2 Holdings Incorporated, ticker symbol QTWO, just filed their quarterly report, and I am seeing some interesting shifts in their financials that are worth a deep dive. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is clearly making some big moves with their money, paying off debt and buying back stock, but it is worth understanding what that means for their future growth. So let us dive right into this report from Q2 Holdings Incorporated. It is essentially a check-in on their financial health for the quarter that ended on the 30th of June 2026. Looking at their balance sheet, the first thing that jumps out is the big drop in cash. They had over $367 million at the end of 2025, but now it is down to just under $100 million. This is a significant change, and it is mostly because they paid off a large chunk of their convertible notes. See this line here, convertible notes, current portion. It went from over $303 million at the end of 2025 to zero by the 30th of June 2026. This means they cleared out a major debt. This payoff is also directly linked to the decrease in their cash and cash equivalents. It is a big move, and it shows they are prioritizing debt reduction. On the flip side, their total current liabilities also saw a big drop, mainly because of that convertible note payoff. This is generally a good sign, as it means less short-term debt pressure. Now, let us talk about shareholders. The number of outstanding shares has slightly decreased from over 62.7 million at the end of 2025 to about 62.3 million by the 30th of June 2026. This decrease is because the company has been buying back its own stock. In fact, they spent over $120 million in the first 6 months of 2026 on these repurchases. This can sometimes signal that management believes the stock is undervalued, or it can be a way to return value to shareholders. Moving over to the income statement, we see that their revenues are growing. For the first 6 months of 2026, total revenues reached over $436 million, up from about $384 million in the same period last year. That is a healthy increase of over 13%. A big part of this growth is coming from their subscription services, which brought in over $362 million in the first half of 2026. This is up from about $312 million last year. This tells us that more customers are signing up for their ongoing services, which is a reliable source of income. Their gross profit, which is what is left after paying for the direct costs of providing their services, has also seen a nice jump. It is up to over $258 million for the first 6 months of 2026 compared to around $205 million last year. This means they are becoming more efficient in delivering their solutions. And this improved efficiency is showing up in their operating income, which is profit from their core business operations. It has more than quadrupled, going from about $12 million in the first half of 2025 to over $57 million in the same period of 2026. This is a really strong improvement. Ultimately, this all translates to a much higher net income. For the first 6 months of 2026, their net income was almost $56.5 million, a huge leap from just over $16.5 million in the first half of 2025. Now let us look at how they are managing their cash. In the first 6 months of 2026, they generated over $116 million from their operating activities. This is up from about $92 million in the same period last year. However, their financing activities show a massive outflow of over $420 million. This is largely due to that repayment of the convertible notes and the stock buybacks we talked about earlier. Because of these large outflows for debt repayment and stock repurchases, their overall cash position decreased by over $267 million in the first 6 months of 2026. This is a big contrast to the increase of over $55 million they saw in the same period last year. The notes to the financial statements give us more details. They mention that the company repaid its 0.75% convertible senior notes due June 2026 in cash. This was a significant event. It is interesting to note that around the same time these financials were released, news reports indicated that Arrow Street Capital Limited Partnership acquired shares of Q2 Holdings. This means institutional investors are still taking positions in the company. Looking at their operating expenses, sales and marketing costs decreased slightly compared to last year. This might seem counterintuitive with revenue growth, but it could mean they are becoming more efficient in their sales efforts, perhaps due to better targeting or digital strategies. On the other hand, their research and development spending increased by about 11%. This is a common strategy for software companies to invest in innovation to stay competitive. They are putting more money into developing new features and improving their existing solutions, especially with the growing trend towards AI. General and administrative expenses, which cover things like executive salaries and corporate overhead, also saw a slight increase. This is often tied to the cost of running a growing company and complying with regulations. Their provision for income taxes went up, but this is often a reflection of their improved profitability. As companies make more money, they generally owe more in taxes. Now, for liquidity, they state they have about $106 million in cash equivalents, and investments. They believe this is enough to cover their needs for the next 12 months. They also have a $125 million credit line available if needed. The company also has a stock repurchase program, and they have been actively buying back shares. As of the 30th of June 2026, they still had about $24.9 million available for future repurchases. Overall assessment. So, what is the story here? Q2 Holdings Incorporated is demonstrating strong revenue growth. Particularly in its subscription services, they have successfully reduced their debt load by paying off those convertible notes, which is a positive for their long-term financial health. The increase in operating income and net income also shows improving operational efficiency. However, the significant decrease in their cash balance and the substantial outflows for debt repayment and stock buybacks are important to watch. While these actions can be strategic, they do reduce the company's immediate cash reserves. The continued investment in research and development, especially with AI, suggests a focus on future innovation, which is crucial in the fast-paced tech industry. The risk I am watching is how the company balances its debt reduction and shareholder return strategies with the need to maintain sufficient cash for operations and future investments, especially given the significant outflow for repurchases. What I'm actually looking for is continued revenue growth driven by subscription services and further improvements in operating margins. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.